The U.S. Federal Reserve has cut rates by a quarter point and is signaling fewer reductions ahead. Joining us for more is Hafiz Noordin, Vice President and Director, Active Fixed Income Portfolio Management at TD Asset Management. And Hafiz, we'll start off by talking about this cut, which was anticipated. It was a hawkish cut, which might have disappointed, a more hawkish cut because it might have disappointed markets. What's your take on this news?
Yeah, well, as you noted, it was widely anticipated, and the bond market had already priced in, essentially 100% priced in, that this 25 basis point cut was going to happen. So there was much less focus on the cut itself and more focus on the Federal Reserve's projections for next year around inflation, growth, and importantly, the number of cuts that they expect, which is communicated by their dot plot. And when we saw that, when the market looked at that, it definitely was a hawkish signal because in September, they had forecasted 4 cuts for 2025. Now the Federal Reserve is forecasting only 2 cuts next year, so 50 basis points of cuts. So that was a meaningful adjustment and is causing some volatility today in terms of the bond market repricing a shallower rate cut path. And so that's also hitting the US dollar, making the US dollar stronger, and also hitting risk assets as well.
Okay, so given that they are indicating fewer cuts next year, what's your outlook on interest rates going forward?
Yeah, and I think what we have to acknowledge is that the US growth story has held up quite well, unlike many other parts of the world, Canada, Europe, China. And even with these rates that are, supposedly above neutral. And so I think there's very much a debate around, how quick they can cut rates. But I think the most important part to think about the bond market outlook or the outlook for 10-year yields is what is that ultimate landing rate, that terminal rate that we call for the Federal Reserve's policy rate. And previously it was expected that was somewhere in the 2.5% to 3% range. The Federal Reserve has now, guided towards 3%, but the market thinks that final terminal rate could be anywhere from 3.5%, even close to 4%. And so I think as we see if job growth can remain solid, even with these higher rates, then that debate around the terminal rate will continue and likely guide towards higher rates. And so I think that's going to really be the main guide for longer dated bond yields, particularly in the US. And I think an important part of that is that it's what we're seeing as divergence in terms of the US growth story versus the rest of the world where we could still see sustained rate cuts. Canada in particular is not seeing that same kind of resilience, both in terms of inflation and in terms of jobs.
Okay, now looking ahead, of course, we have the markets, waiting for Trump's second term. We've got tariffs that could have possible implications for inflation going forward. What is the bond market telling us right now about the path forward on interest rates?
Well, there's definitely concern around some of the negative aspects of Trump's policies or proposed policies, tariffs, mass deportation. Those would be bad for growth and probably inflationary if they're sustained. And that's the key thing, is that there's expectations, but what will be reality? And that's still an uncertainty that we're waiting to see. And on the flip side, there's also some pro-growth ideas that would be good in general, deregulation, lower taxes. So how that all plays out in terms of reality versus expectations, and also what happens in terms of sequencing of those policies will be key to the outlook. And I think right now, everyone's waiting for January when Trump actually does take over and can actually start to put these policies in place. And so until then, I think there will be volatility around assessing those expectations. I think we'll have to watch to see today, does Trump also come out with tweets or, with other types of messaging in an environment where he might be not very happy with the Fed right now, not guiding to lower rates because he wants to cut taxes, he wants to perhaps maintain fiscal deficits, and he needs lower rates to be able to fund that. So I think there's definitely a lot to watch, even leading into his inauguration. And I think volatility will be the norm going forward.
I think one of the implications of Trump's pro-growth policy, lower tax cuts that we've seen this year is the strength of the US dollar. Given your outlook on rates, what does this potentially mean for the US dollar going forward?
Well, we've clearly seen the trend. It's been a stronger dollar since Trump's win. But not only because of Trump, but even just the economic data in the US, again, diverging from the rest of the world, showing its strength. And when you have that divergence, that's when you get big currency moves because the US dollar reflects these higher yields in the US bond market versus lower yields in the rest of the world. And that's when you get capital flow into the US, and that bids up the US dollar. And so for now, it looks like the trend around that remains intact. The data coming out of the US is very solid. And so I think, for US dollar versus the Canadian dollar, which is what a lot of us look at, is now firmly below the 70-cent level. And that's, I think, the first time since around 2003 or so. And it all reflects this idea that right now the expected ending terminal rate for the Federal Reserve is over 100 basis points higher than where the Canadian policy rate will end up. And that divergence between the two countries, we haven't seen for a long time. And so I think we have to be open-minded to the idea that, the US dollar looks expensive, but it could keep appreciating even more versus other currencies.
Okay, so looking ahead to 2025, what are some of the key indicators you'll be watching closely as the Fed considers its move next year? You talked about the strength of the job sector in the US, talked about inflation. What are the things that you'll be watching closely as the Fed considers its next move?
Yeah, well, the Fed is unique in that they've got the two mandates, and it's always a struggle about which of those two mandates are they caring more about. Is it the maximizing employment, or is it about keeping price stability? What we've seen today out of their communication is that they're less worried about the downside risks to the job market. We've seen the monthly job growth in the U.S. Kind of in this not too hot, not too cold range of averaging about 150,000 per month, which is kind of probably around where they want it to be. But what we saw from their guidance in their forecast today is an upgrade to their inflation forecast, their core PCE forecast, which is their main sort of barometer for next year, to 2.5%. Their forecast in September was 2.2% for 2025. So we're seeing kind of this rebound in inflation expectations from their perspective, which is a messaging that they're really focused on inflation data and worried about that part of their mandate and keeping their credibility of price stability. And so I think that's what that we're going to be looking at is how is inflation data progressing. Within that, we have to look at the dynamics between goods and services. Some of the disinflation that we saw this year was largely from goods price inflation coming down. Service inflation price inflation has been coming down as well, but it's still sticky. It's still kind of around 4%, which is still fairly high. And most of the U.S. economy is a service economy. And so to the extent that service inflation stays sticky, that's definitely going to maintain this Fed that will be more cautious about cutting rates from here.